Hello and welcome to another episode of The High Ground, powered by Premier Companies. And today it is just myself, Sal sitting in here with Aaron Bledsoe. And so we've had Aaron in here before to discuss grain and a lot of logistics and marketing. And so today we're going to have, let me give you a timestamp. We are July 4th weekend in 2022. We just finished Independence Day. And this is following that weekend, and we're on a Wednesday, hump day. And give you a little bit of a catch up. We're in the Eastern Corn Belt. We're located in southern Indiana. We're sitting in Jackson County, Indiana, in Seymour in our corporate office. And we have been on a hot, dry run across most of the Eastern Corn Belt, I would say. There's been some spotty showers. But in grain crops, that gives us some problems, right? We can control a lot of variables. Weather, unless we have irrigation, is one we can't control. So, Aaron, tell us a little bit about where we're at today.
Yeah, so the last month has been extremely rough. Whether it be, no pun intended, weather.
Well, yeah, we struggled early with too much.
Mm-hmm.
We needed the Goldilocks weather, and we haven't got it yet, have we?
No,
It's been too hot, too cold, too wet.
Yep.
Too dry.
Yep. And to add insult to injury, December, if I look back a month, so on June 6th, the December futures were trading somewhere around that 702.5 or 702.25. At the close last night, which would have been, July 5th close, we were 578.5. So we lost $1.24. It's up about 4 cents. So we've lost about $1.20 in a matter of a month.
Of opportunity.
Of opportunity, yeah. It's not like, I'm pretty proud of some of the customers that we have. They've hung with us on the marketing plans, and they've actually got quite a bit of crop, a decent amount of crop sold at those high $6 and $7 for corn, a cash price too for fall delivery. So, that 578.5 is futures price, and then you got the basis taken off of it or added to it wherever you're delivering it to, but. We've got some customers that did a pretty good job this year so far. But yeah, we've lost $1.24 in the corn. November futures for beans, this time last month we were 15.33.5, and right now at the close last night we're at 13.16. So that's 2.18. Now beans are up 21 right now, so that puts us at least underneath that $2 loss.
Okay.
On the future side of it.
What drove this, Aaron?
So a lot of it was the acreage and stocks report that came out last week on June 30th. That's always a big report. I mean, it doesn't matter if it comes out exactly like the market thinks it should. It's still a big momentum change, because what it does is you're looking at the stocks of what we went through or what we have left from that 21-22 crop, which was a big crop. I mean, record yields. And then you're looking at the acreage going forward. So you've got this stock situation of the old crop. How much of that are we going to carry into the new crop? And how many acres did we really get planted? They did put a little asterisk out there saying that they're going to revisit the acreage in the Dakotas and Minnesota because of the late planting that they had. So they're going to relook at those acres. They're going to resurvey, but that'll come out in August. So in about a month, we'll see that again. There might be some revision, but we don't know if that'll be an increase in corn acres, decrease in corn acres, or vice versa for the beans.
I mean, Aaron, it seems like it was just a month ago we sat in here, and the market was telling us it wanted corn. Mm-hmm. And that report on June 30th with the acreage, is that what just flipped it?
So the report itself, which we've got a graph, and we can pop it up for those of you looking on or watching us on YouTube. Yeah, you can see it comes from White Commercial. They're the ones that help us be better elevators for our customers. So love the stuff that they give out, but the chart gives the what the estimates were from the analysts, or the really, really smart people that sit somewhere probably in New York and watches all this global news. But so the analysts thought that the acreage report for corn would have been somewhere, or the stocks, sorry, not acreage, stocks would have been somewhere around that 4.3 billion acres, and what the report actually came out was 4.35. So we were extremely close on the stocks. and how that compares to last year. So last year we were somewhere around that 539 3/4 right now in the December futures. Well, the ending stocks at this time last year were at 5.2. So ending stock situation, we're tighter than what we were last year, but the futures are, we're a little higher. We're about 40 cents higher than what we were this time last year. So that in and of itself really wasn't a big game changer. The acreage on the corn, the estimates thought that we would see like about a 500,000 acre increase. They really thought the beans would decrease, corn would increase because of that strong rally that corn had in that April-May timeframe. I kind of doubted that because from a logistical standpoint and input standpoint, all we heard across the entire nation was, it's going to be hard to get fertilizer, it's going to be hard to get crop inputs, just all of that.
Sure.
So I had a hard time seeing corn acres increase, but they found on their survey that they did. So they did see about a 200,000 acre increase on corn. So we went from, I think in March we were at 89.5, now we're at 89.9. So just call it 90 million acres of corn. So that in and of itself with, just the acreage increasing for this new crop, which is where the focus is going to be. We're not focused on the old crop hardly anymore. That's going to be a local market, looking for any hot cash bids that you got out there. That's where you need to focus. But this is all new crop now. We don't really care about the old crop other than how much are we going to carry over. So this new crop with the increase in acres, that was kind of a bearish, but you're not talking very many acres in the grand scheme of stuff.
200,000.
Yeah, and we're still talking significantly less than what we were last year. Last year we were 93.4. So there's still like 3.4 million acres less than what we did last year. So
and stocks are lower.
So you see what we've done, and that $1.24 loss over a month, really that's really came in the last week and a half, 2 weeks.
And explain the asterisk.
The asterisk was on this report that they are going to resurvey the acreage for primarily that northwest Corn Belt area. So like your Dakotas, your Minnesotas, they're going to look at that again.
Quality or quantity?
Quantity.
Quantity. Okay.
They didn't touch the yield yet. This report was only acreage. Okay. So we will see in about 6 days, we will see the July monthly report come out. So I think that comes out on like July 12th or something like that. And that will put a yield to this acreage number now. So there will be a little revision. I think the market will probably want to see a revision lower in the yield because of the weather we're having.
Sure.
We'll see.
Just looking out the window here, certainly looks like it's they're going to lower the expectations.
Yep. The problem is like each one of these monthly reports, they always look back. So they're looking at the month prior. So if they felt, which June was hot and dry, so hopefully that means that they might drop it down a little bit, so that'll be supportive for the futures prices, but we'll see. The big news on this report was beans. The market thought we would see basically whatever corn picked up, that 250,000, we thought we would see the bean acreage go down 250,000 acres. It didn't. They dropped it down over 2 million acres.
Wow.
Yeah. So we went into this thing where we were going to plant more beans than corn for one of the very few times that we ever do that. Now, the analysts were thinking 90.4 million acres, and we came in 88.3. So it was 2.1 million acres lower than what the average analyst said, and yet we've lost $2.
That's a head scratcher.
Yeah. So if you look at just the acreage and you look at the stocks, because the stocks on the beans are tighter this year than they were last year too. So all of this screams that we should have had supportive prices.
Yeah.
And we haven't. A lot of that comes down to what's going on in the world. I mean, I came in here, it's like the new normal now to just say, well, all the crazy stuff going on in the world is what's driving this. This week, in the past couple of days, we have seen where the funds have exited their positions. They've liquidated their positions. And when I say that, that means that all these funds and all these fund managers were in this market, so they bought into this market. When we have outside money buying into this market, it's driving the prices up. When they decide that they want to get out, it can be a bloodbath. And we talked about that a couple times ago, is that when this thing shifts, and it will, it could get bloody. And it has. I didn't think it happened right now, so by no means am I out here saying like, oh, I told you so. No. But when they exit their position, because they had such a large position, they were holding so many corn and bean contracts in the long position, meaning they owned them. When they sold out of it, when you sell into the futures, it drops the price. So that's a lot of what we're seeing right now. To get back to the weather side of it, because this report, I really thought, okay, well, we had a knee jerk to the bottom side, meaning that a lot of people were banking profits, selling out of the market, driving it down. They're going to buy back into it, and we're going to see a rally after. And you see that every once in a while with reports when it's a big, when it's a big one. You'll see a knee jerk one direction, and then it'll start recovering the other. So sometimes you'll see like a bearish report. You'll actually see it every once in a while. You'll see it kind of like pop or something, and then it'll just cut out from underneath there. And a lot of that is just the movement of people trying to get out of their positions and finagle what they're doing. So you'll see the fireworks for the first day. About 2 days later, you'll start to see it settle out, and you'll get the real direction of this market. So I'm glad that we see a little bit of a bump. I think that comes from the weekly crop progress or the conditions, which is where this market's really going to focus on now. Outside of weather, we're trading inflation, global recession. Anytime that you see the dollar get extremely strong, which I think we're sitting on a 20-year high for the U.S. dollar value, and you see oil start to take a hit, which we talked about that. I know Country Mark talked about that, and I came in here and I said that would be the canary in the coal mine to watch the oil market. When you see pressure on the oil market, that's going to put pressure on the ethanol market. So that means corn prices are going to take a hit. And that's what we're kind of seeing right this second. At some point, you have to curb demand. High prices curb demand, which is kind of weird because we're seeing prices just deteriorate. So you start to wonder if we haven't hit demand at some point, hurt it in some way. But right now, my focus is all going to be on weather. That's where we're at. That's kind of what this market's waiting on. This may be a correction. At some point, we needed a correction for the bulls to kind of catch their wind and make another run at this. So, unfortunately, what that next run may be would be a supply issue. And I'm not saying that's going to happen. We could catch a rain. I mean, they're calling for some rain up in, Iowa and the Dakotas and Minnesota. So anytime Iowa gets rain, you're going to see pressure on this market. Number one corn producer in the United States. They have a good year. We're going to see pressure. But that's where this market's really at right now is we need to focus on the weather. Like with you, Sal, I know all the tools that you guys have. Pay attention to or get a hold of your account managers, Sal, all of them, talk to them to figure out what we can do for this crop to get this thing through if we don't get a rain.
Yeah, because we talked a little bit about kind of some break-even numbers. Do you want to kind of go over those a little bit, and then we'll talk about maybe some risk management tools?
Yeah, so for beans right now, after this $2 loss, I put in a $13.05 price per bushel with a $6.50 cost per acre. I'm saying about a 50 yield, 50 bushel average yield across the farm. So at $6.50 with 50 bushels, you're making $3 an acre.
Yep.
So those margins that we had just gone real quick. Now they can come back, but that's where we sit right this second. Corn, I ran $1,000 per acre. Some people are going to be higher. Some people are going to be significantly lower, depending on where they bought into this market and how they run their operations. But I ran about $1,000 per acre with a $5.78 price per bushel, 175 average, and that comes out to making about $12 an acre.
Okay, so that sounds like pretty tough news.
That is, yeah, because 2-3 weeks ago we were making $200 some an acre for corn.
So I guess right now, and if you're one of our listeners, that's we've got a lot of listeners that's not even in this market, they're not even in this industry, and I'll tell you that there is hardly any way to replace just what Mother Nature can bring us in rainfall. And I know I don't know what it would be like to work in an industry where you don't worry about the weather, but that our whole livelihoods revolve around an inch or two of rain and the timeliness. And for our listeners, just kind of as a general rule of thumb, an inch of rain on an acre of land is something less than 30,000 gallons. To put that in perspective about how much water a good rainfall can supply. And right now, our crops are stressed because they haven't had any measurable rain for quite some time in most of the areas. So it comes down to what do we do now? And the good news is there are crop insurance. Almost all growers have a crop insurance program, but they'd much rather have a good yield and get paid for the upside of this crop. There are risk management tools that we have, and matter of fact, we're going to meet tomorrow with the account managers and review them, where we can say, one, I feel like we need the grain. There's just too much in the world. I think that where you're bullish or bearish, I'm pretty bullish that the world needs grain.
Yeah.
And maybe not today, but I think they're going to need it here within the next year. And we need as much grain as we can. And it's a conundrum, because if you've got a crop that doesn't look like it's going to make much at all, or at least past your insurance levels, why? Why do you spend more? Why would you invest more to get more bushels? And that's what it is in agriculture, is that you invest in your crop, and the rule of thumb is the more you invest in care with timely applications of different products, the higher the yield, or the more bushels per acre you'll get. So we've got a program called Impact RX, which we're going to launch, and that encourages growers to go ahead and finish the crop out. And what that does is that if you don't make 105% of your approved APH in corn, and I know that's a lot of acronyms and everything else, but if you don't make a good crop and your insurance doesn't kick in, it'll share some of the risk, and you'll get some money back for that application. So you won't be out the entire application of what you invest in the future. And so we're going to go over some of those, and it's $10 to $25 per acre at this point in the game. Next year we'll have some larger than that, but it'll allow you to go out and try to finish strong with your crop, get a good crop out of it as much as you can, and not be exposed to the entire cost of the application.
Well, that sounds phenomenal. I really like that. I mean, that's the first time I've heard of this. I mean, you're going to talk to the account managers tomorrow, so I'm glad to hear that, because that's kind of the boat that I'm in right now. Anytime I talk to a customer, which the phones have been pretty silent for about a week now, because of the losses that we've taken, but we are in a risk management style now.
Yep.
A month ago, really the last 3-4 months, we've been in a let's maximize profit.
Sure.
Let's know your numbers. Let's set targets. Let's see if this thing hits. And a lot of them did hit. I mean, we had well over $15 beans, target hits. I mean, it was a great run. But due to what this market's doing, we are now into a risk management style. Because the last thing we want to do is how you're trying to protect the crop, Sal. We don't want to protect this crop and then have these futures continue to work against us and lose out on the future side. So it's like you don't want to go out there and try to protect this and make as many bushels as you can and not have a marketing plan on the backside of this to try to limit your risk out there. If you don't have anything sold, I highly, highly suggest you get a hold of whoever you market through, whoever you sell to, get a hold of them, see what your options are. Because I'd rather take some risk off the table at these small margins right now than to possibly get a rain in a week and the market shift another 50, 60 cents down. And all of a sudden you're really, really hurting where you just got a little bit of rain, felt good about doing some extra protection against for the crop to get it through these hard times, but you lose it on the future side. So this is lockstep and key right now in this transition period, because we are in a transition period where we're going from old crop to new crop on the marketing side. So I'm really glad to hear that on from you.
Yeah, and it helps protect us against an average crop.
Yeah.
Because if we get an average or below average crop, that's a bad day in the markets we're in now. And so it helps protect us and gives us a little bit of kind of a backstop against an average or a little bit below average crop, where crop insurance may not have a good play. This will be good tools to manage some risk, to try to because there's some bright side out there, is that soybeans, they do handle drought and stress remarkably well. And I know we've had our agronomist Glenn Longaball on the podcast before, and one of his words of advice is that we abandon beans far too early. And I think that there's still opportunity, and we go out there and we protect what we have, and I think the markets will come, and if not, more bushels won't hurt.
Yeah. And I mean, from the marketing side, how we got to this, because this conversation has turned into how do we protect the crop? We're looking at a stressed crop in our area. How did we get here with these prices? People are talking about 2012 because of the drought. And we are hot, we are dry, especially in our little neck of the woods. 2012, to get those markets to that point, was all supply. We have driven these prices up because of black swan events. We've had 2 years in a row where Brazil struggled on the crop side. This last year, we got used to them producing record crops, and the acreage and the bushels just keep growing out of South America. The last 2 years, we haven't had that. And we had a 2019 where we were delayed, and that crop probably didn't do as well as what the USDA thought it did, and then they finally revised it. So all of a sudden, we start driving up this demand, and last year we had phenomenal exports. And that was at the cost of Brazil and South America. They didn't have a crop, so we took advantage of that, and that drove the prices up. And then we get to this February, and all of a sudden Ukraine gets invaded. So then all of a sudden the market's like, well, oh my gosh, they're going to be able to ship anything out.
Yep.
And all of a sudden now I never thought I'd be talking about the vegetable oil market and sunflower oil, but now all of a sudden people have to talk about that, and they have to figure it out. So we go from South America having struggles, driving prices up, and demand phenomenal for us. So we're pumping bushels out, even though we're producing a bunch of bushels, which you would think when the supply is great, you don't have prices rallying. Simple economics. When you increase supply, you typically see prices go down.
Yep.
Well, we saw supply go up for our neck of the woods, and we're selling it at great prices. And then Ukraine got invaded, and the trade thought, well, they're not going to ship anything out. So all those bushels of corn that they did ship out, typically, probably going to come from the U.S. because we have an oversupply. We look great. Well, they start shipping out a little bit more than what we thought. Still fractions of what they usually do.
Like 20%.
Yeah, I mean, it's not even close, but it's still more than what the market thought they could do. And we're not picking up the excess. It's coming from somewhere else. It's not coming from us. And all of a sudden, India and the Philippines area, they start sending out more vegetable oil than what we had initially thought, palm oil. So that starts putting pressure on beans, where we thought, oh my gosh, these beans are going to be phenomenal. We're already tight stocks. Prices are going to keep going. Things just haven't quite gone the way that they initially thought they were going to go. And even though it's fractions of percentages that everyone else typically does, it's still more than what the analysts thought we were going to do, which is putting pressure on the board. And so going forward, we really have to be careful, because now we're tiptoeing into recession talks, food versus fuel. There's a lot of things going on outside of weather that we have to deal with, and it's a lot to try to think about. Before, it was like, well, do I sell now or do I wait for another 25-cent run and sell now and sell then? So you were fear of losing out on that. Now it's a matter of, okay, where is this thing really going to go? Because we're primed for. A little bit ago, we were either overpriced or underpriced. Well, now it feels like, I don't know. I mean, there's a lot of headwinds going right this second. I still believe that we're probably going to see the yield drop, a national average. I just have a hard time seeing us crank out another 177. I don't see it. I think beans can handle some stuff. I've always liked beans, but I'm still bullish corn. With margins this tight, I don't want to get too far out there. And we went from last time I was on here, we were talking about, 18, 19, when it was like rejoicing your suffering and pulling in the legacy. And now we're in, a month ago, we were like, oh my gosh, this is when we can make our legacy. Well, a month later, all of a sudden we're back to, we got to figure out how to make it through this with what we don't have produced yet and what we don't have sold yet. We got to make it through this.
And Aaron, I think that's a good note to end on, because if the markets have shown us anything in the last few months, is that we may not see the upside come. We may not see the run up coming, and we don't see the run down coming. But one thing's for certain is they can change pretty quick.
Yep.
And it seems like there's always an event. And I think we'll just keep farming and we'll wait for the markets to rally a little bit. And I feel like they will. And whenever we see the quality of the crop that's out there, probably won't be near as much as what it has been in the past. And I think that'll work to our favor. So that's Aaron. Do you have anything else for this session?
Nope. I appreciate it letting me come on, and I apologize if I rambled a little bit. There was just a lot in this, and not really dedicated to the reports anymore. There's just a lot more going on.
Well, and that's just so, if everybody could predict this, right, we probably wouldn't be sitting in this room, would we?
No.
All right. Well, that wraps up another episode of The High Ground, powered by Premier Companies. And thanks for joining us.